Hello, I'm Jonathan Reeves from Tax Matters, and today I'm here with
Claire Hancock from Profit Cash Growth.
and we are two accountants coming from very different spectrums of business, really. And the idea of today is to talk about a question that we received from you guys about tax and accountancy.
Yeah. So we have, despite us both being qualified accountants, we have very different backgrounds and very different specialisms. And we're trying to highlight the importance of business owners in particular getting advice from the right specialist. So we're going to answer the same question, but hopefully show you what a different perspective and different professional advice you could get depending on exactly who you ask.
So the question we're going to answer today is all about directors' loan accounts. Now, but not directors' loan accounts where you're in credit, which is...
So this is really common actually, particularly when people are starting a business because...
Well, you say it's common, Claire, but I don't.
Well, it's interesting. I tend to work with growing businesses. So that would be a business where the director has put money into the limited company to often bootstrap it and get it off the ground. But
That's right.
It tends to also be, even at the... when you're thinking about like investing and growing in your business, is that a lot of the business owners I work with will not take all of the profits out of the business every year in dividends. They'll leave some of it in the business to grow it. So from that perspective, it's quite common that a lot of my clients will end up where their business actually owes them a director's loan rather than them borrowing money from the business.
And what some directors also do is they take a proportion of the profits and also draw down a proportion of the director's loan account, which is in credit, because it can reduce their tax liability as well. So they're getting the income out that they require, but they're only paying tax on the drawings from the company and not the director's loan account that's actually in credit.
So that's quite important actually, because this is something that definitely confuses a lot of people, that when you put money into your business, so say for example you put 50k, 100k into your business to get it started, and a lot of people actually remortgage their personal properties to get their business off the ground or to grow their business. So you put, let's say 100k into your business, and your business then owes you that money.
It does.
And there isn't always the cash flow to take that money back out of your business. So you could end up with a director's loan in credit, as we would call in the accounting world, for quite a number of years.
Yeah,
And
definitely.
there are obviously some considerations from a tax perspective, but also from a business cash flow perspective as well. So we're going to talk through those, aren't we?
I mean, and what I think about straight away is with the director's loan account that's in credit is that you can actually charge the company interest on the money that's yours. And that interest is actually a corporation tax allowable expense.
For your business.
Yeah.
So as an individual, you can give your business a bill for the interest. Yeah. And what I really like about this, and I actually use this in, I've got quite a big buy-to-let property portfolio, and we've got about $750,000 is the director's loan in that company, and we charge our business interest, so it reduces the tax.
As long as
that
it's
the business
a market
pays.
Rate interest, you can claim it, and then it's tax deductible for the limited company.
Yeah.
And then you can draw that down. Now, the only thing you need to think about is that the limited company needs to deduct tax on that interest payment, and you need to report that to HMRC every quarter within 14 days at the end of each quarter.
So that's when interest is paid to an individual. And actually banks used to do this, and it used to be quite similar with how dividends were paid as well, is that if, say for example, you were charging your business £1,000 interest, then actually your business has to deduct the personal tax that's due before your business can pay that to you.
That's right.
So it's not deducting business taxes, corporation tax, that's separate. We've said that you can then deduct that £1,000 from your business tax bill, but as an individual you have to pay personal tax on that as well.
That's right. And so you need to make sure you report that on your self-assessment return every year.
Now, one of, I think, the most common questions is people say, well, it was cash, so I didn't remortgage my home, I'm not paying any interest to loan this money to my business, so I couldn't charge my business interest. But that's not the case, is it? You can, regardless of where that money's come from or whether you're paying personal interest on it or not, you can charge your business a market rate of interest.
Rate.
So,
and the good thing about taking that out, the interest out of the business, is when it sits on your personal tax return, you've got no national insurance to pay on either. So it's a great way. And you can see why a lot of directors, either they go for the paying back the loan early on, or they do a mixed match of both.
Yeah.
And it's a good way of getting money back into you personally and reducing your tax liability.
And there is no actual legal rate of interest that you can charge your business. We've said a few times you need to use the commercial rate.
Yeah.
And me personally, I will get 3 comparative commercial loans and I will take the average of the 3 rates. And
so that's interesting, Claire. What do you think would be up today would be a commercial rate?
It depends on the terms of it. If we're talking like an overdraft, then you're going to be looking at 8-9% interest. But if you're talking like a long-term mortgage that, or a long-term loan that's payable over 25 plus years, then you're going to be a bit lower, maybe down at 6 or 7%. But it does depend on your business circumstances. As an individual, how good your credit rating is and how good your financial history is makes a difference to the interest rate. And it's exactly the same with businesses.
I think that's a wise decision to do some research. Last night when I was looking, the information I was coming up was saying anywhere between 5 and 15%.
Yeah.
So there's quite a big field, and it's a good opportunity if you're charging interest on that. Remember, the company's getting a deduction against its corporation tax, and there you're getting the money back.
Yeah.
It's a good opportunity.
And especially, in the situation where I just said, where I've got about $750,000 in my buy-to-let company, that, interest at 10%, that's quite a staggering amount of money coming back out of my business.
It's a very strange thing because preparing people's personal tax returns at the moment, you are seeing a huge uplift in their savings income because of the way that interest rates have changed in the last couple of years. People who were just maybe getting a few £100s are now getting thousands of pounds and actually having tax liabilities to pay on that, because obviously they're getting taxed very differently, because in a bank you don't get the tax deducted at source.
Yeah.
But through a director's loan account in credit, the company would deduct that and report it to HMRC, as I said, within 14 days at the end of every quarter.
I think as well is that you say you have to report at the end of every quarter, but it's only the quarter that the interest is paid.
Well,
You can, to just keep the paperwork simple, I charge interest once a year.
I would have said, yes, Claire, you're absolutely right. I was going to say that at some point in the conversation.
Yeah, so you have to report it within, there's like, once you've paid the tax, there is a reporting deadline and a tax return that has to be done, but you can pay the tax quarterly and therefore you only have to deal with that quarterly as well, which just helps keep your accountancy fees down a little bit. Because
exactly. It's keeping it simple. That's what we say, isn't it? Is it keep it simple, stupid?
But there are a few things you've got to consider as well with this. So the reason why bootstrapping, I think, is so popular with business owners in particular, not only when you're getting started, but even when you've got an established business, is because it's so much cheaper to get personal finance and to get a personal loan or to get access to a personal loan than it is to get business finance. Most businesses, if you want a loan of any type,
it's difficult, isn't it?
You feel like you have to jump through hoops, and you have to 9 times out of 10 give a personal guarantee anyway, and you need much larger deposits. Generally 20 to 25% is sort of the minimum deposit that you need for a business. But as an individual, you can leverage your home is one of the most common ways that business owners I see raise finances. So
you could raise the finance personally, say an interest rate of 5%, and then you could charge the company, say 10% to cover your costs.
Yeah, absolutely. So you could actually end up in profit. And I think this is probably the biggest question when I see this happening with directors that have got significant loans in their business, is they will say, well, if I'm charging my business 10% interest, let's say that's the rate you agree, I'm actually paying 5% on my mortgage. Can I then claim that 5% on my tax return as an expense? Because you've had to pay to get that loan. You're paying interest to get that loan and then loan it somewhere else. What's your opinion on that?
Wow, there are some rules about buying into partnerships and buying investments where you can claim the interest back, but I'm not sure at the minute.
It is and this for me, this is a massive tax issue on my tax returns personally. I know it's something that I've had a conversation with you, Jonathan, and I've also asked other tax advisors, and they quote various tax laws and cases, but it is really, really quite complex.
It's not straightforward, and it's one of those things where every case was almost judged on its merits. It's a difficult on-the-spot question, Claire, to be honest, and probably is a whole video on its own.
Yeah, that is true.
Right, well, shall we wrap that up for today? And thank you everyone for watching, and we shall see you next time.